Hey everyone, good afternoon. Welcome to the Final Bar. Today we're joined by Willie Delwiche from Robert W. Baird to help make sense of where things are at, big picture style, looking at different asset classes. If you like volatility, you're going to love Thursday, April 16th with all the movements we've had today. It's an up day, it's a down day, it's all sort of volatile. But we'll talk about some of the themes that have emerged. In particular, we're going to look at relative strength and see where the relative gainers and losers are coming from. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's show. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close, break down the technical activity of the day, try to make sense of things from a technical perspective, and then most importantly, connect what we see today with the longer term trends. And my guest today, Willie Delwiche from Baird, is going to, I think, help us put things into context. And I think that's what we're all sort of grappling with, right? This, especially with a volatile day like today, sort of a directionless, sideways, sort of choppy action, where are we at? And I think the good thing about charts in this sort of environment is they help you focus on where the trends are emerging, where the trends are evolving, and when their trends are very much in place. And we'll see from charts like Microsoft, the trends seem to be unrelentingly positive. We'll get to all that in a minute. In the meantime, I did want to let you know about all the events we have coming up on StockCharts TV. Also on this show, The Final Bar. If you missed it, today was part 2 of our two-part series, the Big Board, which was a profile of our visit to the floor of the New York Stock Exchange a couple months ago. And if you missed it, go to our YouTube channel. You can see both of those two parts. It was our visit with Jay Woods, who's one of the executive floor governors. It was a really cool behind-the-scenes look at what's happening there. Coming up on StockCharts TV, going into next week, on Monday, our next episode of Behind the Charts features two analyst strategists from Elliott Wave International. We caught up with them not too long ago at their home office. So we'll hear from Steve Hochberg and Peter Kendall, both from Elliott Wave. On Tuesday, the 21st, we have JC Perez from All Star Charts. Jeff Hughes is going to join us from Minneapolis on the 22nd. And then our friend Tony Dwyer from Canaccord Genuity is going to be with us next Thursday. So again, so thankful, so appreciative. We've brought on I feel like we're bringing out the big guns in this period, trying to get the best guests, the best experts to help us make sense of what's going on, and look forward to hearing from all of those people. So thinking about the market today, getting into our market recap, again, I mentioned it was all about volatility, right? It was all about the fluctuations, and today I think really summarized. I keep certain days just sort of feel like a beautiful little encapsulation of where we're at right now, and I think today was it. It was volatile. In the end, we didn't really go anywhere dramatically. We closed up a little bit, but not in a meaningful way. A lot of that came into in the last, toward the end of trading as things appreciated. But there was a time earlier on in the day where we were down pretty big, kind of out of the open. So, there wasn't a big, huge directional shift. It was more just kind of a digestion day. And when I talk about a digestion day, I mean a day that really didn't move significantly one way or the other. It was more just kind of making sense of it. If you look at the S&P, here's yesterday's close. That was the Dow we were looking at a second ago. If you look at the S&P, yesterday's close kind of right in the middle. You can see we just sort of traded all around that area. The S&P finished right around 2,800. The mid-cap index, the small-cap index, both down a little bit, with small caps the weakest of the three. The VIX now, again, right around 40, just below it by a couple pennies. Looking at a daily chart of the S&P, here we'll switch gears to this one. Looking at a daily chart of the S&P, I think it's worth noting. I sort of cleaned out all the lines and everything that I feel like may have been, clouding things. A lot of times I like to put a lot of work on the charts, use them as a notebook. But I was just trying to get just a clear slate. What do these things look like if I look with fresh eyes? And again, what strikes me about a chart of the S&P is obviously the huge sell-off from February to March. The divergences become more and more clear. And again, I know we were all watching the market during these periods. These divergences don't seem so obvious in the heat of the moment. In the rearview mirror, they always look a lot more obvious and explicit than they do as you're trying to navigate things day to day. So don't beat yourself up too much if you miss some of these divergences during the day as they're forming. It's actually pretty tough sometimes. But overall, what really drives home for me is this retracement. We're right about at 50%. I could draw lines in, you don't really need them to see. They're about halfway of the way back up here, and that's why we use a semi-log scale. It does it on a percentage term, so halfway is about 50%. Percentage-wise, we're right below the declining 50-day moving average, which really hasn't been in play for a while because we've been so far below the moving averages. We're now back up to the point where on the S&P 500, the question is it able to eclipse that declining 50-day moving average? It lines up with sort of that 28.50 level, which lines up with previous support. That's about the 50% line. A lot of different measurements give resistance around this area. So it's just, again, for me, it just keeps reminding that we're right sort of at that, really significant line in the sand. And then the RSI is another thing that, I'm usually drawn to. And the fact that we haven't eclipsed 60 in a bear market phase, you usually never really get above 60 as you're sort of continuing downwards. So that's sort of what the daily chart looks like from my take. In terms of what happened today, and again, our segment a little later is going to be focusing on relative strength, and we'll get into some individual stocks that have emerged in positions of strength in the last couple days, last couple weeks. But I did want to focus on some of the sector rotation. So healthcare was really leading the way today, up over 2%. So while the S&P finished in the positive, finished more toward the highs, healthcare really is what drove things higher there, followed by consumer discretionary and technology. Again, I keep mentioning Microsoft as sort of the poster child chart. It's in some ways a vote of confidence that things are going to be okay, but arguably it's almost more of a safe haven. It's a place where you'd hide out if you want to ride things out, because something like Microsoft's probably going to do okay while other things start to suffer. At the bottom, we had energy leading the way lower, so sort of back to a normal environment, I guess, energy-wise, with that suffering. And then financials have been relatively weak as well. And second from the bottom this time, bring up a chart of the XLF really quick. And again, what strikes me on financials, we talked about this on the show yesterday, sort of this bear flag pattern. A lot of charts are sort of showing something like this, which is a big decline and then this parallel channel that's sort of a counter trend move, right? So while in the short term this seems very positive, and it is, that tactical time frame has been undeniably positive with higher lows and higher highs. That's an uptrend, right? But if you look, the longer, the one higher level is this big sell-off and then this parallel trend upwards. And what usually is a mark of this bear flag pattern is you have this parallel channel of highs and lows. And so after the big sell-off, you have this counter trend move. And then more often than not, this usually resolves lower. And the basic measurement is you take the flagpole, or you take the entry into the pattern, and you subtract that from the lows, which puts it way down here on the XLF. So I don't know if we're necessarily going to get all the way to those lows, but I would tell you a break below this trend line is going to get a lot of people speculating. We're right at that point. We closed either right at it or just below it, depending on how you draw the line. So I think follow through tomorrow. If we get further confirmation of that breakdown, I think that's going to suggest pretty painful trend, certainly in financials and arguably for the overall market going into next week. In terms of industries and what sort of emerged, I mentioned healthcare was number one. Healthcare providers, certainly the number one group. And you can see that was up 5% today, followed by broadline retailers within consumer discretionary, the toy group in there as well, both up 3.4 to 4%. The gold mining group, which would be Newmont Mining and some other names you may know, up 3.4%. Other than that, a sort of a mix of things. You have other mining in here. You have trucking, but also biotech, semiconductors. Biotech has been a fantastic group and some of the better charts out there. AMD is a semiconductor. Sorry, Regeneron. I was going to say it's not AMD. I was looking at the tickers real quick. Regeneron is the top ranked biotechnology stock. There are many others in that top 20 list, and so biotech has been a pretty decent group. Semiconductors as well, and that's AMD's group, which is the number one scooter ranking stock. So you have some sort of bellwether groups that have been doing well, continuing to emerge in positions of strength. And again, the more that chips away to the upside, I think the better you can feel about things, to be honest, overall. In terms of the groups that were down a lot, airlines certainly feeling the hit. They had a nice sort of bounce yesterday related to the bailout and sort of getting details on how that's going to emerged for some of the larger U.S. airlines for sure. But today, back to reality, down another 7%. So again, I feel like the movement in airlines kind of mirrors what a lot of us have felt. There's sort of great news and something spikes. But again, 9 or 10% out of incredibly depressed levels is still down a lot. And that's what we have to remember. So today, again, back down pretty significantly. And then you can see E&P, equipment and services, some of the other energy groups represented there on the bottom 10 charts as well. So plenty down there. I did want to highlight just one chart from our Mindful Investor Live chart list, and we'll go through this tomorrow as part of our normal Friday routine of wrapping the week. But I did want to just point out a quick chart or two. Number one, we've talked about the breadth characteristics, and again, we're sort of in a choppy week here with yesterday and today, but the cumulative advanced decline lines across the cap tiers, this is something that we look at pretty regularly. It's something I'm certainly paying attention to and seeing whether this trend continues. It looks kind of like the chart of the XLF, which is a bit of a concern. But again, if we start breaking down through the trend line support, if you connect those lows, that would be a little more concerning than it is. At this point, it's sort of just telling you tactical uptrend and pretty safe. Last thing I'll point out is just the absence of new highs. And again, even though the market has rallied on this tactical time frame, I still feel like that intermediate term and the long-term time frame is still relatively weak. And again, the absence of new 52-week highs just reminds you that very few stocks are back up to this, the February high level. They're sort of recovering, but still with more upside to go. And that's what the broad S&P is telling you. We've only retraced 50% of the way, which means we're still down a decent amount from the previous highs. There's a lot more of a recovery to be made before we could signal an all clear, feel a lot better about the long-term trend. So still feels like tactical positive, that medium and the long-term still relatively negative based on some of the charts that I'm seeing. That's our market recap for today. And again, so many movements. And again, on a volatile day, you had a lot of divergences of stocks doing well, stocks starting to struggle a bit, especially in financials. We're going to take a quick commercial break, be back right on with my guest, Willie Delwiche. We'll see you in a minute.
Hi, I'm Julius the Campanar.
And I'm Arthur Hill, and you're watching SCC TV.
Hello, everyone. Welcome back to the Final Bar. I'm Dave Keller here at StockCharts.com. I want to remind you, we do a mailbag segment a couple of days every week. We're going to do one again tomorrow. So if you have any questions about particular charts, about technical indicators, about decision-making, behavioral finance, market structure, whatever it is, anything's fair game. We'll do our best to help point you in the right direction. So shoot us an email, thefinalbar@stockcharts.com, or just give us a follow on Twitter @finalbarsctv. Mention our tag, and we'll definitely capture those. And again, love to answer your question on our show tomorrow. I want to bring on my guest, Willie Delwiche from Robert W. Baird, joining us from the Milwaukee area. Willie, welcome back to the show.
Thanks, Dave. Thanks for having me.
Good to have you on. And you sent a couple charts ahead of time, which we appreciate. The first one is looking at what looks like the last year, the performance of some of the different cap tiers. What is this telling you about where we're at?
Well, yeah, so this is a chart. It looks at the S&P 100, 500, 400, 600. So mega caps down to small caps. And it says to me that we've still got a market of haves and have-nots. The haves are the large caps, especially the mega caps that are flat to maybe up a little bit over the past year. S&P's down a few percent, but then you get into mid caps and small caps, and you're looking at 20% plus declines over the past year. I would add to this, even if you break it out in the S&P 500 itself and look at 6 names. I've seen them called the fan mag. I won't be able to list all of them right now because I'll probably forget a couple of them, but you can imagine what they are. They're up 25% over the past year. The S&P 494 is down 10%. So this is really, you've got a few things holding up the market, and and I think you alluded to this earlier, you've got a lot of things that are still very, very weak, even after we've bounced off of the March lows a bit.
It's such a great chart, Willie. And if I could ask you, so do you see this as more descriptive, just showing the characteristics of, a narrow group of mega cap names, the fan mag stocks that are just continuing to be the strength? Or is it more prescriptive, meaning the fact that small caps, mid caps have not been as participating, is that a danger sign, right? Is it more descriptive or is it more telling you about inherent weakness?
Well, I think it's both. It's certainly interesting just to see what's happened over the past year. But then if you break it out and look at, say, ratio between OEX versus SML, so mega caps versus small caps, if we were starting to, in the early stages of a sustainable rally, you would expect small caps to be doing well. What did we see today? We saw OEX with a new high relative to small caps. So that's a little disconcerting which I'm fielding a lot of questions. Are we going to retest? Have we made a bottom? The discrepancy between mega caps and small caps says it's pretty early to think about that just yet.
So it's a great chart. Chart number 2 is looking at more of an asset allocation sort of thought, right?
Yeah.
We have stocks, copper, and then the 10-year yield. What are you seeing here?
Yeah, so this is, we can look within stocks to gauge the strength of any move. We can also look across asset classes to say, this price rally we've seen in the S&P 500, is that getting sponsorship or credence from copper, from bonds? And copper isn't awful, but I'd say it's not nearly as strong as S&P 500 has been. The big warning sign for me is what's happening with bond yields. If we were in a position to be thinking about sustainable rally and the lows we're in, I would expect to see bond yields starting to rise in anticipation of better economic data, and we've got the opposite right now. We've got the 10-year T-note yield is hugging not its absolute lows, but pretty darn close. And so the move in the S&P 500 not getting the sort of support and endorsement from copper, and certainly not from bonds, that you would expect if we were in the early stages of a sustained move higher rather than just a bounce off of oversold levels.
It's such a great chart. And again, what I love about both of these, I feel like we can get very trapped into just thinking about the S&P 500 in a vacuum, right? And just thinking about what the market's doing, quote unquote, and you're kind of showing how that relates to other things. If I could ask, so with the S&P then, so I get what you're saying. It's sort of giving that impression that it's bear market rally kind of, coming higher, but it doesn't feel like we're in the sustained rally mode. What is there something that you would see technically or otherwise that would tell you, what, all clear, we're going to go to new highs? I feel like S&P 3400 is coming soon. Is there a certain level or a certain signal, or what would you need to see to convince you more along those lines?
Sure. So I think price alone in this environment is not a good indicator. We've seen so much emotion come into the price move off the highs and now the price move off the lows that I think we need to look beneath the surface. Specifically, I'm looking at breadth thrusts to see where we can find those. We talked about in a piece I just published today that we've got something like 99% of stocks are above their 20-day averages. So we bounced, but still relatively few of them are even making 20-day highs. And so we're not seeing it from that perspective. We're not seeing a sharp expansion in the number of stocks trading above their 50-day moving averages or 200-day moving averages. So I really think we need to see more of that sort of indication beneath the surface to say these price moves aren't just volatility related, but there's actually a trend that's emerging that can be sustained.
That's a great take, Willie. Thanks so much for coming on. I don't know if it was your son that you quoted in your tweet earlier, but either side has the Gandalf. We'll have to see who emerges, right? Let's take control of things. Listen, be safe. Best to you. Thanks again for coming on the show, Willie.
Yeah. Thanks a lot, Dave. Talk soon.
All righty. Take care. There's Willie Delwiche from Robert W. Baird joining us from the Milwaukee area. Just such a great take. And again, it's a great reminder. I think so often we get caught with the blinders on in some cases, right? Focusing on the S&P or whatever stocks we're looking at. I think Willie does such a great job of just relating what we're seeing at the high level with other things that can sort of validate or invalidate what you're seeing on the broad indexes. So a great discussion there. We're going to move on to our next segment, which is called It's All Relative. And the goal here is to focus on relative strength. You've probably seen the charts that I bring up. A couple observations. Number one, you could probably see my technical approach is very simplistic. And people have asked me at times why it's so simplistic. And I always tell them most of my career has been spent working with people who are not technical analysts, who are not technically oriented. And I'm trying to help what I do, help it resonate in their own process. And so I've always try to use things that I think are grounded in behavior, grounded in investor psychology, but also are readily, easy to explain. So my charts tend to be straightforward and tend to tell the story. And you'll notice at the bottom, more often than not, I have the relative strength line, which is looking at that particular stock relative to other stocks. And usually it's relative to the S&P, but you can do it relative to the sector, relative to the industry, all of those. And if you're not familiar with stock charts and you're not sure how to do that, you add an indicator at the bottom. The indicator is called price-performance, and then you just put in the ticker. So if you do this HD:SPY, it's going to do relative to the S&P, but you can also just use $ sector, $industry, and it'll automatically update based on whatever ticker that you show. So it's pretty flexible, allows you to look at relative strength pretty easily. So what I wanted to do is just show you a couple lists of names of stocks that I think have done pretty well. This is one in particular called relative strength. Nope, that's not it. I'm looking at 13-week highs I wanted to jump to. Here we go. S&P 13-week highs. I'm going to run that scan. So this is one that I've set up a while ago, 21 stocks that emerge on that list. So a pretty decent list. This is updating actually intraday, if I remember right. So the list is going to fluctuate depending on what we're seeing. We will pop this in a list. We'll preserve sort order, and we'll say, okay. So this is giving us a list of charts making new 13-week highs today, and let's get to them. So, what's represented, so there are a couple communication services names, and some of these are tickers we've looked at, but Akamai Technology is actually breaking out to a new closing high today. Again, a nice up move, up almost 5.5% at a time when the S&P was up about, a tenth of that, 50 basis points. So pretty nice move, and breaking to new 52-week highs, breaking above there. The RSI not quite overbought. The relative strength not quite to a new relative high because other stocks have been in much more in rally mode, but it's really accelerating here in the last week, and that's why the relative strength has turned up. We've talked about the video game names Activision and Electronic Arts earlier in the week, and I think we've seen a continued follow through, so up 3.5% today. Activision, and again, not quite at a new relative high for the year, but very, very close. This is Electronic Arts, again, not quite at a relative high, but the relative strength overall has been really good. And if you think about this, if you envision the chart of the S&P, it's kind of down here somewhere. And again, stocks like this are actually breaking to new price highs. So stocks that have been able to recover all the way past their peak from February. This actually one actually topped out in January. That's pretty impressive of a run at a times when other stocks have been struggling. Again, there might not be some names that surprise you. Netflix certainly has been in a position of strength. It's one of the top 10 stocks in our scooter rankings, not quite at a new relative high because it really peaked out in March when it rallied so quickly out of the low. So some of these stocks that were sort of the coronavirus bucket of names that you'd expect to do really well as things were cratering, had a nice spike in relative strength, kind of came back to earth as everything else recovered. But these are stocks that are now starting to emerge again. That's why Netflix is in pretty decent shape. Now, some of these like Amazon, this is one that has broken to new price highs a number of days now in a row. It has gone to new relative highs now, new relative highs for the last 12 months, which is impressive. Very overbought. So I think the challenge with some of these, they've really gone vertical. What's interesting about Amazon, this is actually a rare stock that's overbought, but actually nearing the extreme overbought region. And more often than not, when we get an RSI above 80, that tells you at the very least we're going to get one more gasp higher. This is actually surprising. In February, we didn't get that based on what usually happens. Usually you get a much bigger move higher after that extreme overbought region signal. So we're nearing again that signal of extreme upside momentum, real leadership. But again, what concerns me about something like Amazon is that it's really gone vertical, and that doesn't tend to be sustainable. Within consumer discretionary, you also have Dollar General, not quite a new relative high, but certainly breaking out of a long-term base. Within consumer staples, you have ConAgra products, which has done pretty well, but it's testing significant resistance. So compare this to some of the earlier charts, which had gone already to new price highs, new relative highs. This one's still sort of chipping away at that. So in the same group, you have General Mills, which has emerged to a new price high. Relative strength actually consolidating. So you'd love to see it break to new relative highs here, sort of accelerate more relative to the rest of the market. Also within the same sector, consumer staples, we have Hormel HRL and Smucker's SJM. So a number of consumer staples popping up in there, not quite the most impressive relative charts, but price charts that have actually held up really well. And it's interesting that they're all clustered in that consumer staples group. Walmart also within staples, again, the relative strength still consolidating, but price going to new highs. So it's going to new highs when a lot of things are not. Just a couple more charts to finish up our segment on relative strength. Market access is within the financial sector, but it's more in the investment services bucket. Nice break out of a base breakout out for the last 10 months or so. Price making new highs, relative strength making new highs. So that's actually emerging in a sector that's really been struggling. So if you look at this stock relative to the financial sector, it's really going to impress you because the average financial stock has been difficult. And then finally, there are just a number of names within healthcare that are worth paying attention to. So Abbott Labs, ABT in the pharmaceutical space, right at the overbought region, but breaking to new relative highs, which is pretty impressive. Centene, CNC, again, a nice break to price and relative highs, which is impressive. Insight, INCY, not quite at a new price high, but the relative strength really emerging. And that's kind of, again, in general, if you want to outperform the S&P, Tom Bowley has told me many times you want to own stocks that are outperforming the S&P. So owning charts that look like this, where the relative strength continues to impress, that's going to be in general, the things that leave you on the right side of the overall market environment. So that's our segment. It's all relative. If that was of interest to you, I would encourage you to recreate that screen, or you're welcome to shoot me an email, thefinalbar@stockcharts.com. I can send you. It's a pretty easy text to copy and paste to run those lists. The other things, if you're looking for something else to look at, go to your dashboard and bring up the market movers page and look for the stocks that are up. And again, not that alone should be what draws you to them. Look at the charts one by one, and you'll find some of those stocks that are emerging to new price and relative highs. We need to wrap up our show, though, and go to the 3 and 3 charts in less than 3 minutes, but folks, we're going to do it no problem. Chart number 1 is looking at growth versus value. And again, the chart of Microsoft continues to do pretty well, and that's why one of the reasons why a chart like this continues to do pretty well. Those big growthy names have continued to do very nicely, especially in technology, in healthcare. Those have been the strength, the price, and the relative strength. And so that's why the pure growth index versus the pure value index continues to go higher and higher. And again, until that really meaningfully dips lower, I think the value trade is just not there yet. It still tells you that people are sticking with the big growth names. And remember, growth versus value does not mean momentum. Those are actually two different things. It might be a subject of a segment we do at some point to clarify that a little further. Second thing is the chart of Microsoft. And again, just because we're in the Seattle area and located headquartered in Redmond does not mean that's the only reason we're pitching. I'm showing you Microsoft. I do think when one of the largest stocks and largest companies in the world continues to make relative highs, I think that lines up very well with what Willie was showing us earlier, Willie Delwiche, about the underperformance of mid caps and small caps. If something like Microsoft is outperforming this much, that means the big mega cap names are really driving things higher. That means a lot of other names are going to be underperforming relative to the strength there. But again, as long as this continues in this uptrend, it's hard to imagine the market could go dramatically lower until you get a breakdown in something like Microsoft. And then finally, the chart of healthcare. Healthcare was such a non-factor, and I stopped looking at it for a while because the relative strength was just so flat. So it's sort of, why even go there? You broke out of the base going into year end, but then again, it struggled like everything else did and sort of underperformed. But then the sell-off in stocks really accelerated the uptrend in the relative strength. The recovery has been impressive as well. And now the XLV making new relative highs for the last year. And that's driven from biotech. That's also driven from healthcare providers, other charts that look pretty decent. So overall, healthcare, I think, has emerged as one of the best places to look right now in terms of potential upside. Ladies and gentlemen, that's our show for today, The Final Bar. I want to give a special thanks to our guest, Willie Delwiche from Robert W. Baird, for joining us virtually today. I want to remind you, we'll do another mailbag segment tomorrow, The Final Bar at StockCharts.com. Send us your questions. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Say be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.